Welcome back to the Profitable Mindset Podcast. Today we're going to be tackling a topic that's really changing how we invest
Oh, yeah.
and support innovation. Crowdfunding.
It's such a cool concept.
Yeah,
It is.
it really is. And
Yeah.
it's a landscape that is just filled with exciting possibilities.
There's so many possibilities.
And
yeah.
let's be honest,
Right.
a few pitfalls along the way.
You got to be careful.
Yeah, you do.
Yeah,
So
yeah.
we're going to provide you with like a guide,
Yeah.
a practical guide to navigate this crazy world.
That's great.
Joining me today is a seasoned investor
Oh, wow.
and a true expert in all things crowdfunding.
I'm happy to be here.
I'm so happy to have you here.
It's great to be here.
Now, I think a lot of people, they hear crowdfunding and they think,
Yeah.
oh, this is like a new concept.
Right.
But the idea of collective funding
Has been around forever.
has actually been around
Yeah.
for centuries.
Centuries.
Right.
Absolutely.
Like, historically, we've seen this
Yeah.
in various forms.
Yeah. Different forms for sure.
Think about war bonds.
War bonds.
Used to fund national efforts.
Oh, yeah. To support, big.
Or even
Yeah.
early publications.
That's right.
The subscription models that were used to finance
Yeah.
artistic projects.
Things like that.
Right.
The concept of people just pooling their money together for a common goal,
Yeah,
not a new thing.
it's not
No,
at all.
not at all.
And of course, the
Right?
internet has completely transformed
Oh, yeah.
this whole landscape,
For sure.
taking crowdfunding to a whole new
a
level.
whole other level.
Right.
Absolutely.
Like late 1990s,
yeah.
we saw the rise of the first internet-based crowdfunding efforts.
Right.
And then in 2009,
2009.
platforms like Kickstarter
Kickstarter, the big one.
really took center stage
Yeah.
and created
Yeah.
this dedicated space for creative projects
Right.
to connect with potential backers.
Exactly. This was a huge
Turning point.
Yeah.
Right. It
Right.
really democratized
I was sure.
the whole process, giving creators a way to bypass traditional
like the old ways of doing things.
gatekeepers
Right.
and connect directly with their audience.
Exactly. You cut out the middleman.
Yeah,
You go straight to the people that care about your stuff.
exactly.
And that's the beauty of it.
And then the 2010s
Right.
ushered in a wave of
Oh,
regulatory changes,
regulatory change.
like the JOBS Act,
JOBSA.
which really paved the way for equity crowdfunding.
Equity crowdfunding.
And suddenly everyday investors
Yeah, not just.
could own shares in startups,
Yeah.
not just big institutions.
Yeah. Right.
That was another game changer for sure.
It was.
Yeah.
Another game changer. It really leveled the playing field.
Yeah,
So
absolutely.
a sense.
Yeah, opened up opportunities that weren't there before.
Yeah.
For a lot of
Yeah.
people. For a lot of people.
Yeah.
And now as we move forward,
Mm-hmm.
we're seeing how technologies like blockchain, cryptocurrencies are shaping the future of crowdfunding,
It's constantly evolving.
particularly for those
Yeah.
interested in the trading
the
world.
Trading world.
Right.
Yeah, for sure.
It's evolving constantly.
It is.
It's fascinating
It is.
to see
Yeah.
how this landscape is constantly innovating.
Yeah.
But before we kind of dive into
Yeah.
the nitty-gritty
Yeah.
of finding those golden opportunities,
Yeah. We gotta.
let's take a step back
Yeah. Sit up.
and break down the different types of crowdfunding.
Right. There are a few key ones.
There are a few key ones
Yeah.
that our listeners
Our listeners should understand.
should understand.
Yeah. Right. Absolutely.
There are four main types:
Four main type.
equity,
Equity.
rewards-based,
Debt-based.
debt-based,
Also known as peer-to-peer lending.
peer-to-peer lending,
And donation-based crowdfunding.
and donation-based crowdfunding.
Okay.
Yeah.
Each has its own appeal.
They all have their own pluses and minuses.
And its own set of considerations.
That's right.
Um.
So let's start with equity crowdfunding.
Okay.
Okay.
Equity crowdfunding.
Yeah.
Now, I've heard this is basically like
It is.
buying stock in a company,
Yeah.
but on a smaller,
Often earlier stage.
earlier stage
Yeah.
scale.
That's a great way to put it.
Yeah.
So with equity crowdfunding, you're investing in exchange for ownership stakes in a company.
Oh, okay.
So yes, you become a shareholder,
Oh, wow.
sharing in the profits if the company succeeds.
That's cool.
Yeah. It's particularly appealing for those who want to be part of a startup's journey
From the ground up.
from the ground up.
Yeah.
Yeah.
So there's that potential for high returns.
High return.
But also the inherent risks that come, right? There's always risks.
With investing in early stage ventures.
Early stage, yeah, anything can happen.
Right.
Exactly. It's crucial to understand that the company might not succeed.
Right.
And you could lose your investment.
Yeah, and that's a great point.
Yeah.
Risk management
Risk management is key.
is key.
Yeah.
Now, what about rewards-based crowdfunding?
Rewards based.
This one seems particularly popular for creative projects.
It is very popular.
Yeah.
Yeah, so with rewards-based crowdfunding, you're not getting equity. You're getting non-financial rewards
Oh, interesting.
in exchange for backing a project.
Okay.
So think of it like pre-ordering a product or supporting an artist's album launch.
Okay.
You might receive exclusive merchandise,
Cool.
early access to the product,
Yeah.
or other perks as a thank you for your contribution.
So it's less about the financial return
Less about the money.
and more about being a part of something you believe in
That's right.
and getting something cool in return.
Getting something cool. Exactly. It's a way to directly support creators
Yeah.
and get something unique in the process.
Okay.
Now, moving on to debt-based crowdfunding,
Okay.
also known as peer-to-peer lending.
Peer-to-peer lending.
This is more akin to traditional lending,
Okay.
but with a modern twist,
Right. So instead of going through a bank,
right?
you're lending money to businesses
Yeah.
or individuals
Yeah.
through these online platforms,
That's right.
earning returns via interest payments.
That's right. Platforms like Lending Club,
Lending Club?
yeah, connect borrowers with investors,
Okay.
often offering relatively predictable returns and structured repayment schedules.
So it can be an appealing option for those seeking like a more fixed income approach
Fixed income.
within the crowdfunding landscape.
Yeah, for sure.
Yeah.
Yeah.
It offers a different kind of risk-reward profile
Different.
compared to equity crowdfunding.
Exactly.
go.
Exactly. And finally,
And finally, we have donation-based crowdfunding.
donation-based crowdfunding.
So
This one's pretty straightforward.
Pretty straightforward.
Yeah,
It's
true.
all about supporting a cause you believe in.
That's right. Whether it's a charitable organization,
Mhm.
a community project,
Mm-hmm.
even a personal fundraiser.
Right. So platforms like GoFundMe fall into this category.
GoFundMe.
Yeah.
It's purely altruistic.
Yeah.
No expectation of financial return.
Okay.
It's all about contributing to something meaningful to you.
Got it.
Now, the key takeaway here is that there's no one-size-fits-all approach to crowdfunding.
Right.
Understanding these different types
Mm-hmm.
allows you to choose the one that aligns best with your financial goals
Yeah.
and risk tolerance.
That's a great point.
Yeah.
It's about finding the right fit
Finding the right fit.
for your investment strategy.
Exactly.
Now, let's say someone is interested in exploring these crowdfunding opportunities. Maybe they're looking for that next big thing to invest in,
Yeah.
or a project they're passionate about supporting.
What are the key things
What should they be looking for?
you should be looking for?
Yeah, what are those signs
What are those signs
for the high potential campaign?
of a high potential campaign?
Well,
Yeah.
the most important thing is to go beyond the hype.
Okay.
Do your research,
Mm-hmm.
dig deep into the project,
Yeah.
understand the product or service being offered,
Okay.
assess the market demand,
Mm-hmm.
and most importantly, scrutinize the team behind it.
Okay.
A strong, experienced team
Yeah.
is often a key indicator of a campaign's potential.
So it's not just about the idea itself.
It's not just about the idea,
It's about the people who are going to bring that idea to life.
the people behind it.
Right.
Yeah, absolutely. Investigate the founders.
Okay.
Look at their track record,
Mm.
their experience,
Yeah.
even their communication style.
Interesting.
Do they have a history of delivering on their promises?
Yeah.
Are they transparent and responsive?
Good question.
These are all crucial factors to consider.
It's like due diligence for startups.
It is. It's due diligence.
Yeah.
The
Making sure you're betting on the right horse,
right horse.
so to speak.
Exactly.
Now, the financials are obviously a critical piece of this puzzle.
Of course.
Right.
Yeah.
I imagine analyzing those projections
Yeah. You got to both.
is a must
You have to look at the numbers.
for any serious investor.
For any serious investor, you can't just go on gut feeling here.
Right.
You got to look at the projections.
Yeah.
You need to carefully evaluate the financial projections,
Oh, wait.
revenue forecasts, cost structures, funding goals, profit margins,
Mhm.
all of it.
Yeah. And be on the lookout for red flags.
Red flags.
Anything that seems
And flags.
too good to be true.
Overly optimistic,
Overly optimistic. Sorry.
ambiguous, or raises concerns
Yeah. Anything that just doesn't quite sit right.
about the project's financial viability.
Financial viability.
Right.
Yeah.
Are there any specific red flags that kind of jump out to you?
Those warning signs that might signal a need for
Extra caution.
extra caution.
Definitely one major red flag is a lack of transparency.
Okay. Lack of transparency.
If the projections lack detail,
Yeah.
they're vague,
Mm-hmm.
or avoid addressing potential challenges,
Right.
that's a sign to proceed with caution.
Got it.
Another thing to watch out for is overly aggressive growth projections.
Okay.
If the numbers seem too good to be true, they probably are.
They probably are, yeah.
Right.
It's about
Yeah.
grounding those projections in reality.
In reality.
Looking for a balance.
Finding that balance.
Between ambition and feasibility.
Ambition and feasibility. That's a good way to put it.
Yeah.
Yeah. And always pay attention to the contingency plans.
Contingency plan.
Every project encounters unexpected obstacles.
Right.
It's inevitable.
It is.
Does their budget include a buffer for these unforeseen events?
Oh, that's a good question.
Do they have a clear plan for navigating potential setbacks? These are critical indicators of the team's preparedness and their ability to adapt.
It's about their resilience.
Resilience.
And their ability to problem solve. When things inevitably
things are going to go wrong.
don't go according to plan.
They always do.
Right.
Yeah.
Now, we've talked a lot about the analytical side.
The numbers.
The numbers.
The data.
But I think it's also important to acknowledge the emotional aspect of investing.
There's a lot of emotion in investing.
Yeah.
Yeah.
Crowdfunding can be exciting.
It
can be easy to get caught up in the hype.
The hype. Especially if it's a project you feel passionate about.
Right. The hype. Especially if it's a project you feel passionate about.
If it's a project you feel passionate about.
Right.
Right.
Yeah.
You're absolutely right.
Emotional decision-making is one of the biggest pitfalls in crowdfunding.
Yeah.
And frankly, in investing in general.
It really is.
Psychological biases like FOMO. Overconfidence.
Yeah. Herd mentality can cloud our judgment.
Yeah, when you get caught up.
And lead us to make decisions we might later regret.
And then we're like, oh.
Yeah. Hindsight's 20/20.
Yeah, why did I do that?
Right.
Right.
Yeah.
I think we've all been there at some point.
We've all been there.
Getting swept up.
Yeah.
In the excitement.
The excitement.
Maybe not thinking as clearly.
We're not thinking as clearly.
As we should.
Yeah, it happens.
It happens.
It happens. And that's why having clear investment criteria.
That's why it's so important to have.
It's so crucial.
Investment criteria.
Right.
Define your goals.
Understand your risk tolerance and create a strategy you can stick to.
Yeah.
Don't let emotions.
Don't let your emotions
drive your decisions.
Drive your decisions.
That's such a valuable reminder.
It is.
Logic over emotion.
Logic over emotion.
Especially when it comes to your finances.
Especially when it comes to your finances.
Yeah.
Exactly. Now we've talked about
individual campaigns.
Individual campaigns. But diversification is another
such an important
key principle. Applies to everything.
To crowdfunding.
Yeah.
Just as it does.
Just like in traditional investing. Yeah, don't put all your eggs in one basket.
Right. That age-old advice.
That's right.
Don't put all your eggs in one basket.
It's just as relevant in crowdfunding.
It is.
Don't overcommit to a single campaign.
Right.
No matter how promising it seems. Spread your investments across different types of crowdfunding, different industries, different stages of development, and even different geographic regions.
Wow.
Right.
So it's about creating a balanced crowdfunding portfolio.
A balanced portfolio.
Just like you would.
Just like you would with stocks and bonds.
With stocks or bonds.
That's right.
Exactly.
Exactly. By diversifying your investments.
Yeah.
You're mitigating risk. And increasing your chances of success in the long run.
Long-term success.
That's the key.
That is the key.
Yeah. It's all about, spreading that risk.
Yeah.
And creating a portfolio that, reflects your overall investment strategy.
Investment strategy, yeah.
Now, there's one aspect of crowdfunding that I think often gets overlooked.
What's that?
The potential for networking.
Oh.
And collaboration.
Interesting. Yeah.
Yeah.
You're right. It's not just about
Right.
putting money into a project,
right,
waiting for the returns, right? It's about becoming...
You're part of a community.
Part of a community.
Yeah.
Right.
Crowdfunding platforms can connect you with founders, fellow investors, and industry experts.
Oh, wow.
Yeah. It's a valuable opportunity to build relationships.
Yeah.
And gain insights beyond the financial return.
So how can we leverage crowdfunding? To build those valuable connections. Yeah, how do we do that?
Yeah.
The key is active participation.
Active participation.
Engage with campaign communities.
Okay.
Leave thoughtful comments. Ask questions.
Yeah.
Share your expertise.
Okay.
It's about contributing to the conversation.
Yeah.
Not just passively observing.
Right.
Social media is another powerful tool.
Social media.
Follow creators you're interested in.
Oh.
Join relevant LinkedIn groups. Participate in online discussions about crowdfunding and investing.
So it's a way to kind of expand your network.
Expand your network.
Stay informed.
And stay informed.
Right.
Exactly.
And don't forget about crowdfunding events.
Oh, yeah, events.
Like webinars, workshops, in-person gatherings.
Right. Well,
these provide opportunities to
meet people.
Face-to-face.
Face-to-face.
Learn from industry leaders.
So many avenues to explore.
There are.
Right.
Yeah.
Now, I imagine it can feel a little overwhelming.
It can be overwhelming to navigate these online spaces.
Yeah, because there's so much going on.
Especially when everyone is vying for attention.
Everyone wants to be seen.
Right.
Right.
How do we actually stand out?
How do you stand out?
And make those meaningful connections.
Meaningful connections, that's the key.
Yeah.
It's about adding value.
Okay, adding got it.
Offering your expertise, sharing insights. Being helpful and supportive.
Yeah.
Focus on what you can contribute to the community, not just what you can gain from it.
Not just what you can gain,
Build relationships based on mutual benefit.
So it's about fostering genuine connection.
Genuine connections.
Not just transactional.
Transactions.
Right.
Right. Yeah, and the benefits can be substantial.
Oh, wow.
You might gain access to exclusive investment opportunities.
Really?
Founders often share upcoming campaigns with their networks before they're publicly available.
That's huge.
Yeah. So you get kind of a first look.
The first look.
Like,
yeah, that's a huge advantage.
It is.
Being in the know early on.
Yeah, early on.
Collaborative ventures are another possibility.
Collaborative ventures.
You might connect with investors.
You could.
Who share your vision.
Yeah, find some like-minded people.
And pool resources.
Pool resources.
For larger projects.
For bigger projects, yeah.
Or partner with a founder.
Partner with a founder.
To bring a new idea to life.
Bring something new to the world.
Don't underestimate the value of learning from others.
Learning from others is so valuable.
Experienced investors.
Yeah, people who have been there and done that.
Founders.
Yeah, they've made the mistakes.
They're often willing to share.
They're willing to share.
Their knowledge and insight.
Their knowledge, their insights.
Helping you avoid
those common pitfalls.
Common pitfalls.
Yeah.
Refine your strategies.
Refine your strategies, get better.
It's like having a network of mentors. And advisors at your fingertips.
At your fingertips. Yeah, so don't just focus on the financial aspect of crowdfunding. Embrace the networking opportunities.
Embrace those opportunities.
Build those relationships. Learn from others.
Learn from others.
It can be incredibly rewarding both personally and professionally.
I love that holistic approach to crowdfunding.
Holistic approach. Yeah.
Now, shifting gears a bit.
Shifting gears.
Let's talk about
Let's get into
analyzing those financial projections
in a little more depth.
Let's dive deeper into the numbers.
We touched on the basics earlier.
Yeah.
But it's such a crucial aspect.
It's so important.
Of due diligence.
Due diligence.
Right. Where do we even begin?
Where do we start?
Dissecting
the numbers.
Yeah.
These numbers.
Well, think of financial projections like a roadmap.
Okay, like a roadmap.
They give you a glimpse into the projected financial journey at a project.
Of a project, okay.
They typically consist of several key components. Revenue projections.
Cost structure. Funding goals. Profit margins. A breakdown of how the funds will be used and the projected timeline.
Okay.
And milestones.
So each element.
Each one.
Kind of tells a part of the story.
Right. Exactly. Now let's start with revenue projections.
Okay. Revenue projections.
These are estimates of the income a project expects to generate.
Okay.
But it's not just about the numbers themselves.
Right.
It's about understanding the assumptions behind them.
Okay.
What's their pricing strategy?
Okay.
What are their sales volume expectations? How are they factoring in market growth and competition?
So it's about scrutinizing those underlying assumptions.
Making
sure they're
grounded
in reality.
Right. Next, we have the cost structure. This is a detailed breakdown of all the expenses
involved in developing and delivering the project.
Makes sense.
Manufacturing costs. Marketing expenses. Salaries. Operational costs. Everything needs to be accounted for.
Everything, okay.
And it's important to differentiate between fixed costs.
Okay, fixed costs.
Which remain relatively constant.
Fair.
And variable costs. Which fluctuate with production or sales volume.
Okay, so understanding this dynamic. Is crucial.
Yeah.
Because it directly impacts profitability.
Of course.
Which, of course,
key metric.
is the most important thing.
We need to analyze.
At the end of the day.
Right.
Profit margins.
Profit margins, okay.
The difference between revenue and costs tell you how much profit the project is expected to generate.
Okay.
Healthy margins.
Healthy margins.
Indicate efficiency and sustainability.
While low margins might signal potential challenges. However, it's important to consider industry benchmarks.
Okay.
And the overall financial health of the project.
Right.
Sometimes lower margins in the early stages might be acceptable if there's a clear plan for scaling and increasing profitability over time.
So context is key.
Context is key.
Understanding the bigger picture.
The big picture.
As a long-term vision.
Where are they going?
Right.
Exactly. Now, you mentioned funding goals.
Funding goals, yeah.
How much money they're aiming to raise.
Right.
What do we need to know about this aspect?
Yeah, like how do we kind of break that down?
It's crucial to understand how those funds will be used.
Okay, how they're going to use the money.
The use of funds section should provide a transparent breakdown of how the capital will be allocated.
Okay.
Is it going towards product development?
Marketing. Research. Operational expenses.
Okay. This transparency builds trust and confidence.
Yeah.
It also gives you a sense of the project's priorities. Whether their spending aligns with their stated goals and whether they're allocating resources effectively.
It's like a project management plan.
It is like a project management plan.
Outlining the steps.
Laying it all out.
They'll take to bring their vision to life.
To make it a reality.
Now, I know analyzing financials can be...
It can be daunting.
Especially for those who aren't finance professionals.
Right.
Are there any practical tips?
Are there any tips or tools?
That can help us navigate these numbers.
Navigate those numbers.
Effectively,
yeah, for sure.
Yeah.
One approach is comparative analysis.
Okay.
Compare the campaign's projections with industry standards.
Okay.
And the performance of similar projects.
Okay.
Are their revenue growth rates realistic?
Good question.
Are their cost estimates in line with industry benchmarks?
Okay.
This comparison provides valuable context.
So it's about seeing how they stack up.
How do they stack up?
Against the competition.
Yeah.
And whether their numbers make sense.
In the broader industry landscape.
Right.
Exactly. Another valuable technique is sensitivity analysis.
Okay.
This involves testing how changes in key assumptions, like sales volume or pricing, might affect the overall financial picture.
Okay.
You essentially create different scenarios to see how resilient their projections are.
So it's about stress testing their model. Understanding the potential impact.
Yeah, what if this happens?
Of different variables.
What if that happened?
Identifying potential vulnerabilities.
Yeah.
Right.
Exactly. If a slight change in one variable dramatically alters the projected outcome.
Yeah, that would be a bad sign.
That might be a red flag, indicating overly optimistic assumptions or a lack of flexibility in their plan.
That's a crucial insight.
It is.
Understanding the robustness
of
their projections. Now, speaking of red flags, let's revisit those warning signs.
Let's go back to those warning signs.
That should make us pause.
Make you pause.
And dig deeper.
And dig a little deeper.
Before
making an investment.
Before you put any money in.
Right.
One of the most obvious red flags is a lack of specifics. If the projections are vague, lack detail, or gloss over potential challenges, that's a cause for concern.
Yeah.
You want to see a well-thought-out plan. Not just wishful thinking.
Right.
Transparency is key. Willingness to address the complexities and potential obstacles. Not just paint a rosy picture.
Yeah. What other red flags?
What other red flags should we be aware of?
Another major red flag is overly aggressive growth projections.
Overly aggressive growth?
If the numbers seem too good to be true, they probably are.
Yeah, right? Too good to be true.
Compare them to industry averages.
Okay.
Look for evidence to support their claims and consider the competitive landscape.
Yeah.
Unrealistic expectations are often a sign of inexperience or a desperate attempt to attract investors.
Right.
They're just trying to get your money.
They just want the money. Yeah.
It's about scrutinizing those growth projections.
Projections.
Making sure they're ambitious yet achievable. Not just pie-in-the-sky numbers.
Not pie-in-the-sky.
Now we've talked about unrealistic growth.
Unrealistic growth.
But what about unrealistic profit margins?
Unrealistic profit margins. That's another one.
Another warning sign.
Yeah.
Excessively high profit margins, especially in competitive industries, might indicate inflated revenue projections or underestimated costs.
Right.
It's important to understand the industry dynamics and look for reasonable and sustainable profit margins.
So it's about finding that balance.
Finding that balance.
Healthy margins.
Healthy margins.
That reflect a realistic understanding.
Realistic of a market.
And the cost of doing business.
The cost of doing business.
Right.
Exactly. And finally, be wary of inconsistencies.
Inconsistencies. Okay.
Do the numbers add up?
The numbers have to add up.
Do they align with the information presented elsewhere in the campaign?
Right.
If you spot inconsistencies or contradictions, that's a signal to dig deeper.
Dig deeper.
And seek clarification.
Seek clarification.
Yeah, don't be afraid to ask questions.
Ask questions.
It's about making sure the story they're telling with their numbers is consistent and believable.
Consistent and believable.
Now we've covered a lot of ground here.
We have a lot of ground.
And it's clear that analyzing financials is a critical skill.
Yeah, it's critical.
For any crowdfunding investor.
Any crowdfunding investor.
It might seem daunting at first.
It can seem daunting.
But remember, there are resources available to help you.
There are resources.
Absolutely.
Okay.
There are online tools, financial advisors. And even crowdfunding community.
Crowdfunding community.
Where you can connect with experienced investors.
Experienced investors.
And ask questions.
Ask those questions, yeah.
Don't be afraid to seek guidance.
Seek guidance.
And build your knowledge base.
Build that knowledge base.
That's such a valuable reminder.
It is.
Learning is an ongoing journey.
It is.
And there's always support available.
There's always support.
Yeah, you're not alone. Yeah, you're not alone in this journey.
We're wrapping up our deep dive into the world of crowdfunding.
It's been a fun journey.
It has been.
Yeah.
And I feel like we've covered so much ground.
We have.
Already.
So much.
Understanding the different types of crowdfunding.
Yeah, all the different types.
To dissecting financial projections.
Yeah.
And even uncovering those hidden networking opportunities.
Networking opportunities.
Right.
Yeah, it's been great.
There are a few essential points I want to reiterate before we wrap up.
Yeah, let's hit those key takeaways.
Yeah, one thing that really stuck with me.
What's that?
The importance of thorough research and due diligence.
Oh, it can't be overstated.
Yeah.
Before you commit a single dollar.
Right.
Dig deep into the project. Understand the product or service.
Yeah.
Assess the market demand. And scrutinize the team's experience and track record.
Like conducting your own...
Like a mini investigation.
Before you invest.
Before making any investment decisions.
Decisions.
Right.
Exactly. And remember, analyzing financial projections is crucial.
Understand the revenue forecasts, the cost structure, the funding goals, the profit margins, and how they plan to use the funds.
Yeah.
Look for those red flags we discussed.
Yeah, those red flags.
Anything that seems overly optimistic, ambiguous, or inconsistent.
Right, those financials.
Yeah, they tell a story.
They tell a story.
And it's our job as investors to read that story carefully.
Yes.
Looking for both the positive signs and those potential warning signals.
And I want to emphasize the importance of emotional discipline.
Oh, emotional discipline.
Crowdfunding can be exciting.
Oh, yeah, it's easy to get caught up.
It's easy to get swept up in the hype or the fear of missing out.
The fear of missing out, FOMO.
But remember to stick to your investment strategy.
Stick to your plan.
Define your risk tolerance.
Yeah.
And make rational decisions based on solid research.
Research, not emotions.
Not emotions.
Sometimes it's about taking a step back.
Taking a step back.
Detaching from that emotional pull.
Yeah.
And really evaluating the opportunity objectively. Yeah. And never underestimate the power of diversification.
Diversification.
Don't put all your eggs in one basket.
All your eggs in one basket.
Spread your investments across different types of crowdfunding, different industries, and different stages of development to mitigate risk.
Mitigate that risk.
And increase your chances of long-term success.
Creating that balanced crowdfunding portfolio.
What a balanced portfolio.
Just like you would with traditional investments.
Just like stocks and bonds, exactly.
And remember.
Yeah.
Crowdfunding is not just about the financial returns.
It's not just about the money.
It's about being part of a community.
Being part of a community, yeah.
Engage with campaign creators.
Yeah, talk to them.
Fellow investors.
Industry experts.
Industry experts.
People in the know.
Network, collaborate, share insights.
Share those insights.
And learn from each other.
Learn from each other.
Those connections.
And lead to.
Can lead to amazing things.
Invaluable opportunities, partnerships, and even friendships.
Crowdfunding.
It can be an amazing.
It can be an incredibly rewarding experience, both financially and personally.
Financially and personally, yeah.
By understanding the process.
Understanding how it works.
Doing your research and avoiding common pitfalls.
Avoiding those pitfalls.
You can make informed choices that support innovation.
Support innovation.
And potentially yield significant returns.
Those big returns.
Crowdfunding isn't just about backing projects.
It's not just about backing projects, no.
It's about betting on the future.
Betting on the future.
It's about supporting the ideas, the innovations, and the entrepreneurs.
The people who are making a difference.
Who are shaping the world we live in.
Absolutely.
Thank you for joining us on the Profitable Mindset podcast.
It's been a pleasure.
We hope this episode has empowered you to navigate the world of crowdfunding.
Navigate that world.
With confidence.
Confidence.
And make informed decisions that align with your financial goals and values.
Your goals and values.
Until next time.
Happy investing.
Happy investing.